Okay, so now we're going to talk about indefinite life intangibles and definite life intangibles. Indefinite life intangibles are different because they don't have a fixed life. We will be selectively impairing those items. For non-goodwill intangibles, those that are definite life, you test those yearly or more frequently, just like PP&E. If economic, if general economic conditions suggest that you should impair the item, you should do it more frequently than a year, but at the very least every year. If book value exceeds the fair value, then the impairment loss for a definite life intangible is going to be recognized for the difference. So it's a little more simple. We don't have what we call the test of recoverability. So we don't look at the future cash flows of the asset, we look at the fair value of it. It's book value. If book value is greater than fair value, then we impair, because once again, this is an overstatement, right? Our books have overstated what we could sell this asset for, so we need to bring it down. If book value is an understatement of the fair value, we don't impair. The cash, well, and so we don't have the test of recovery. We go straight to the book value and fair value, and then the impairment loss is going to be equal to the fair market value, or I'm sorry, the book value minus the fair market value. Either way, just understand that that's your loss, the distance between these two. Also, with the impairment of intangibles, there's no need for the accumulated depreciation entry. Any amount of impairment is just a debit to impairment and a credit to the asset directly. So that is intangibles that are not goodwill or not indefinite. But an indefinite, like goodwill impairment, is going to be a lot different. So there was a recent new standard put out that said companies have to first do a step one. It's almost like a step zero. You just decide whether it's more likely than not, greater than 50% chance, that goodwill is in need of impairment, right? Before, it was tested on a yearly basis, but companies said that hiring valuation specialists to test the goodwill every year was a little bit overzealous and a little too expensive. So they created a list of sort of standards as to when it would be, what are conditions that might exist to make you think goodwill should be impaired. So macroeconomic conditions can play a part. If you have limited ability to access capital as a company, if we're in a slump, in a bear market, foreign exchange rates are going unfavorably to the business, anything like that, any sort of market or security market crises. The industry and market considerations. So is your niche disappearing? Is there increased competitors? Is there a change in the demand of products? Any cost factors, like maybe the cost of your raw materials went through the roof, there's a shortage, and so now demand, supply's dropping and prices are rising. Overall financial overall financial performance, profits, losses, string of losses might be an indication of decreasing goodwill, and so on and so forth. You can kind of read through those yourself. Because goodwill is so distinct from other assets, finding its fair value is very tricky. It's also very expensive, as I mentioned before. You have to go through and assess fair value of all assets and liabilities for a company in order to find goodwill. And this is, of course, only if you have the book value of goodwill on your balance sheet, because otherwise there's no need to impair anything, right? Because goodwill has a lack of association with contractual rights or privileges, those would be a separately identifiable intangible asset. Because of that, you have to be very careful, and it's very difficult to determine what is its fair value. So the way that they do it is actually they look at what is the fair value of all assets and liabilities, um, and then we get our fair market value of net assets from that, right? It's just the FMV of assets minus the FMV of liabilities. Once we have that, then we can compare it to the book value of net assets. And we can decide whether or not we have to impair goodwill. That's the next step, sort of. But there's also another step. You got to make sure you impair all the other assets. So, for example, if I don't impair one of my assets, its book value, and it needs to be impaired, the book value of my net assets will be overstated. Okay. If that's overstated, then we may impair goodwill at the risk or at the error of not impairing an asset. So, if, say, we had some radical example where we had a piece of equipment that had a book value of $1 million too high, we would impair it. If we don't impair it, that asset will be $1 million too high, which may cause me to say, ooh, the book value of my net assets is too high, right? Because if I don't impair that one item that's $1 million too high, this will be $1 million too high, but I'll attribute it to goodwill rather than the asset that's actually overstated. So you have to be careful. Determining whether impairment is necessary. So, like I said, you look at the book value of assets, of net assets, to the fair value of net assets for the reporting unit or segment. The jargon is the reporting unit. That's where we want to apply the impairment. So the book value of net assets greater than the fair value of net assets, then we apply impairment. It's necessary. Again, it's an overstatement. If they are less than, none is necessary. Determining an impairment loss to apply to goodwill is when we look at the difference between the fair value of goodwill and the book value of goodwill. To determine the fair value of goodwill, it looks silly, but this is how we do it. We compare the fair value of the net assets of the entire company and then compare it to the fair value of net assets of the company without its goodwill. That is just mathematically set up to give me the fair value of goodwill. After I have a fair value of goodwill, I can then look at the difference between the two, the fair value of goodwill versus the book value, and then record a loss to bring the book value down to the fair value. It is a very step-by-step process, and make sure that you work a lot of problems with this, because this is typically where my students have issues. So looking at this next problem, the book value of assets, the book value of liabilities is given to you, fair value of assets and liabilities is given to you. I give you fair value of assets without goodwill, and then I give you the book value of goodwill. So this is for a company, and I say, go ahead and suppose that we meet the test for deciding that we need to, it's more likely than not that goodwill has some impairment to it. So I first look for the net assets of both my book value and my fair market value, because I want to compare those two numbers first. I have a $500,000 difference here. That's my book value of net assets. And it looks like a $400,000 difference here. This is the fair value of my net assets with goodwill. So that's the first comparison. $500,000 book value is greater than the $400,000 fair value, which implies goodwill impairment is necessary. So notice the test for whether it's necessary is about all of my net assets, right? Not just goodwill itself, because I haven't even looked for it yet. Now that I know it's necessary, I need to find what is the fair value of goodwill. In order to find the fair value of goodwill, right, I have to take the fair value of goodwill of the fair value of the company with goodwill, which I already have, 400,000, and then subtract off the fair value without. Well, the fair value without, I have assets of 9.5 million without goodwill. And then I would subtract off the fair market value of my liabilities without goodwill. Oops, 9.175. That'll be a much different calculation. So 9.5 minus 9.175 would give me what the net assets were, which comes out to 325. That's my fair value without goodwill. Again, remember this is net assets. That's my fair value of goodwill. Now that I have my fair value of goodwill, how much do I impair it by? Well, then I need to recognize a loss on impairment of 25,000 and credit my goodwill account to bring it down to 75,000. Right. Cost subsequent to the acquisition of assets. We could have an addition, improvement, or repair. The basic ideas still hold. Expense, if it does not increase the service value, if it's just maintaining the current service value, and then capitalize if we're going to get some greater benefits out of it. So the additions are going to be new components on existing assets. Independent additions operate independently of the original fixed asset. So we have their own useful life. If it's a dependent addition, like a new floor on a building, components that enhance machinery, then it cannot operate independently of the original fixed asset that it was added to. So it's going to be the shorter of the additions useful life or the original fixed asset's life. So this is just sort of compared to PP&E used only for a natural resource, something like that, if you remember from chapter 10. Improvements and replacements are substitutions, right? Improvements substitute a better one. Replacements substitute a similar asset. And the way that we're going to record it is going to depend on whether or not we have a book value that is determinable for the piece that we replaced. So for these, I want to first assume that we have a book value. And now I'll show you two ways you could do this. So if you have a book value for the asset, you want to get rid of the old one. Now, this process would depend on whether you actually have pipes as the asset, or if, so let's say pipes is the primary asset. It's the account title, or maybe it's just a part of a building, right? So either way that you organize the information, it's going to be basically the same entry with just different names. So for example, in this one, we replace old pipes that had a historical cost of 80, accumulated depreciation of 70. We have some new pipes going in. So we would have, new pipes as a debit, because those are the new ones. We're going to debit that account. We're also getting rid of the old pipes, and they had a historical cost of 80,000. And they had accumulated depreciation that we can now wipe off the books, right? So that $70,000 of accumulated depreciation goes away. We get some cash on the deal. We have, we don't. I was going to say we could assume, but if we did get some cash, because one of your problems do. So I'll say assume we sell pipes that are old for scrap of $3,500. So we're getting some money off of this. We can, if we're getting 3,500, we're spending 10,000. The net of that then would be 96,500. That is the cost of new minus scrap of the old. And after this is 167.5, 176.5, 170. So we have an overall loss on replacement, or just a loss. It doesn't have to be on replacement, even though technically that's what we're doing, of 6.5 thousand. Now, if we just recorded a building, exact same journal entry, only instead of saying pipes, I say building, right? The building gets debited by 100,000. The accumulated depreciation that is associated with the pipes, but overall the building is going to be debited. We are going to take out some of the old building, because if we recorded it as a building and we spent $80,000 on the pipes, that would have been a capitalized cost into the building, right? Cash would be, again, 96,500, assuming that we got 3,500, and then we still have a loss on replacement, because that's what the loss on replacement, right, goes on the books for whatever the book value was, less any money we get from selling that stuff. So the book value of those pipes was 10,000. Since we got 3.5 thousand that's in here for scrap, it's only a loss of 6.5. Okay. Suppose that we don't know the replaced asset. So in this case, I say we have a building. The original cost of it was $2 million. We have a salvage value of 400,000 and a useful life of 40 years. Suppose 20 years has gone by. So if 20 years has gone by, the historical cost less the salvage suggested that I have an allocation base of 1.6 million. If I divided that over 40 years, I would have been depreciating at $40,000 per year by 20 years. Results in $800,000 of accumulated depreciation. So that means that the book value at the beginning of the year for this particular building would have been 1.2 million. That's the book value at the beginning of the 21st year. Now, if I spend money and it increases the service potential of the building, then I want to debit that directly to the building account. I don't know the cost of what I'm replacing or its accumulated depreciation, so this is the best I can do, right? Add $100,000 to the building. Well, at that point then, we would have the building account. It would have been at 2 million. I added 100,000 to it, so now it's at 2.1 million. The accumulated depreciation account started the year at 800,000. Now, after I add this value to the building, my depreciation for the year is going to change because I had a book value of 1.2 million. I added the $100,000 improvement, which added to my historical cost. That's going to increase my book value. I subtract off the salvage that I'm working to, and the remaining years are going to be 20 years remaining. 20 years have passed, 20 years are still going. That's $45,000 a year now. So I would add that at the end of the year, my balance sheet presentation, let's say at the end of the year, after I assess depreciation, of 45,000 would be 845,000. So 2.1 less 845 gives me $1,255,000. That would be the book value on the books. If the new plumbing increases my useful life by 5 years, then the process is a little different. The journal entry is going to be to accumulated depreciation as a debit, so it erases some. If I debit accumulated depreciation, I am increasing my asset. This does increase the book value because I'm subtracting less from the historical cost. And I modify it the same, 100,000. Now, the difference is I have my building has not been altered. It's still at 2 million. My accumulated depreciation began at 800. I took off 100, and then I would have to assess new accumulated depreciation. So the new accumulated depreciation, or the new amount for the year, if the balance sheet presentation is for the end of the year, would be, well, first, after I've made this journal entry, this is reduced to 700,000. So my book value is 1.3 million. And again, I still have a salvage of 400,000. So that's going to be over 25 years now because I added 5 years to the useful life of the asset with the improvement. And that was stated in the problem, or that was stated in this part of the problem, which is now a different sort of depreciation expense only because I have those extra years. So 36,000 depreciation per year, I would add now to accumulated depreciation. That would be 736,000 of accumulated by the end of the year. So then the balance sheet at the end of the year would be 2 million less 736,000, which leaves me with $1,264,000 as the book value. Okay. And the final thing in this chapter then is talking about repairs and maintenance expenses. If there are even distributions of repairs, just do debit expense, credit cash, right? If there is a non-even distribution of repairs, then you should have an accrual of a quarterly expense with a credit to an allowance for repairs maintenance. And then over time, as you actually spend money, you credit cash and reduce your allowance for maintenance. And at the end of the year, you would reverse any existing allowance for repair and maintenance because that would be an overestimate of necessary repairs. So you charge too much expense, now you're going to reverse some, right? So that's how that's dealt with. It's very similar to the allowance accounts we've seen in the past, right? Just know that you do them when they are unevenly distributed. When there's even distribution, you just charge expense. Okay. I would also like you guys to work this problem, this example of goodwill impairment. I have the answer key posted, and this problem with repairs and improvements. And then we will work the other goodwill impairment question in class, the other ones on your notes. All right.